Tariffs are rising again, and markets are paying attention. Thanks for joining us for our quarterly investment perspective. First, a quick market review. Q2 was a tale of two halves for global markets. Stocks started the quarter with a sharp sell-off after the U.S. announced sweeping new tariffs in early April. But as some of those measures were rolled back or delayed, investors' sentiment quickly recovered, driving a strong rebound. By quarter end, U.S. stocks delivered double-digit gains, led by tech and AI-driven names, especially the Magnificent Seven. International markets also performed well, largely helped by a weaker U.S. dollar. On the bond side, returns were modest but positive. Corporate and securitized bond sectors led the way, while municipal bonds lagged amid heavy issuance and tax policy uncertainty. Long-term treasuries also underperformed as concerns over inflation and government debt levels pushed long-term yields higher. It was a volatile quarter, but one that ultimately rewarded disciplined investors who stayed the course. Looking ahead, the backdrop for markets remains constructive, but not without risks. Corporate earnings are expected to hold up, especially with earlier estimates already revised lower after the tariff shock. Many companies may still deliver upside surprises, even as input costs rise. Global central banks are shifting toward easing, and continued strength in consumer and business spending should help support stock valuations and earnings growth in the months ahead. Trade policy remains a key wild card, with recent negotiations underscoring the potential for renewed volatility. Fed policy is also in focus as questions around leadership and independence continue to stir investor concerns. And of course, geopolitical risks, particularly in the Middle East, could create further disruption. On the bond side, high-quality sectors remain attractive, offering solid income and potential price gains if growth or inflation softens. All in, the outlook supports staying invested, but staying prepared. Let's turn to the economy, starting here in the U.S. After a slight dip in Q1, growth resumed in the second quarter. We saw strong consumer spending and job gains early on, but the pace slowed slightly as the quarter progressed. Rising concerns about inflation and policy led to more caution. Business investment cooled, and confidence surveys dipped, but steady hiring and easing inflation helped the economy regain its footing by quarter end. Abroad, growth also picked up. Europe and the UK cut interest rates, while improved factory output and exports provided a boost to Japan, South Korea, and parts of Southeast Asia. In China, stimulus efforts showed early signs of traction. However, trade tensions and geopolitical risks continued to dampen global consumer confidence. Looking ahead, U.S. economic growth is likely to stay modest, but positive. A strong labor market and steady consumer and business spending should keep things moving forward. The recently passed One Big Beautiful Bill adds some short-term fuel, with retroactive tax cuts that could give business investment a boost. On the monetary front, the Fed has held rates steady, but markets are betting on a cut as early as September if inflation stays in check. Together, policy support, steady hiring, and resilient demand should help keep the economy moving forward, though trade policy remains a wild card. So let's talk about tariffs. They've been a major source of market volatility this year. Back in April, sweeping new U.S. tariffs triggered a sharp market sell-off. But as implementation was delayed and trade talks advanced, investor sentiment improved. Markets rebounded sharply in Q2, fueled by hopes that a broader trade war could be avoided or at least managed. Now, with August here, some of those tariff increases have started to take effect, while others have been reduced through deals with the UK, Japan, Vietnam, and more recently, the EU. But elevated tariffs remain in place for several key partners, and the risk of further escalation hasn't gone away. So, what does it all mean? Some companies have managed the impact, and consumer spending has held up so far. But business optimism has cooled. Hiring plans are softened, and tariff-related inflation may continue to build gradually over time. While the path forward is uncertain, there are still good reasons to stay the course. First, markets have weathered protectionist swings before and recovered. Second, the economy remains resilient with steady spending and earnings. Third, companies are adjusting, realigning supply chains and absorbing costs. And fourth, some of the most aggressive tariff measures may prove temporary, whether through negotiation or legal intervention. So while uncertainty remains, staying diversified, disciplined, and invested has never been more important. In today's market, it's easy to feel pulled in different directions. Stocks are hitting new highs, but headlines warn of rising tariffs and inflation. Rates haven't come down yet, but the dollar has dropped. Crypto is soaring, and AI-driven stocks continue to dominate the headlines. It's natural to wonder, am I missing out? Or should I be taking risk off the table now? Our view? Stay anchored to a thoughtful long-term strategy. Q2 was a reminder of why diversification works. While early volatility tested portfolios, those with broad exposure held up well and participated in the rebound. International stocks outperformed. Most bond sectors posted gains, and value-oriented areas like real estate and infrastructure provided ballast when growth stocks faltered. Rather than chasing trends or reacting to fear, we believe in disciplined rebalancing, trimming areas that have run ahead and reinvesting in those that haven't. We don't need to predict the next move in rates or the dollar. What matters more is building portfolios aligned to long-term goals, resilient across cycles, grounded in fundamentals, and positioned for what comes next. If you found this information helpful, please click like. Click the subscribe button to be notified of future videos. Thanks for watching.